Yep. See if I can get the clicker to work. There we go. Great. Hi. I just want to thank the Tax Foundation for arranging this event. It's always nice when something that you work on gathers a little public interest. So this is a project, like Scott said, that we've been working on at Treasury for quite some time. So that's going to explain the change in affiliation for my co-author, John McClellan, who's now at the Congressional Budget Office. But while he was at Treasury, he worked with me and several people in the office on this project. The disclaimer that's necessary here is that this is not work that comes out of Treasury or CBO. These views and opinions are mine and my co-authors, so don't call the press office over there. But what this paper is going to do is it's going to look at a cash flow tax. We set it up sort of in the overarching theme of economics, but the goal of the paper is to get down to a micro simulation and look and see for a historical panel of firms what this movement to a border-adjusted cash flow tax would do to the tax base. So it's to provide some empirical evidence. Obviously, right now, this is a hot topic for policymakers. So currently, policymakers have expressed a clear interest in reforming the US tax system. What are we looking to do in reform broadly? Simplification. I think everybody can agree that the US tax code is a complex animal. And so to the extent that we can simplify it, that's definitely a goal of tax reform. From a macroeconomic perspective, we would like to improve incentives for investment and growth. I think that's broadly always a policy goal of the US. And then in particular, in the recent decade and a half, we've been thinking hard about location decisions. We want to minimize those distortions to the extent firms want to move money or profits offshore. So the truth is that if there was an easy fix for this, it would have been done already. And so because there's not an easy fix, it opens the door for sort of broader reform options to be considered. And so the goal of this paper is to put some numbers to that, to think about a historic panel and look at how the tax base changes for a 10-year period. So why do we think about a cash flow tax? That's not the only option out there. This is an old question for economists. You can trace some of the terminology back to the Meade Commission in 1978. It's something that we've kicked around at Treasury, in an informal and formal capacity. Most recently in the 2005 panel on federal tax reform. This was part of that package of things that was considered. When you want to think about the goals we were trying to get to, one was simplicity. So income is broadly difficult to measure and subject to a lot of gaming on the part of corporations. So cash flow is a simpler way to go. And then the idea would be eventually that all businesses and not just corporations would be taxed under this system, although what we're going to consider right now is just going to be subchapter C corporations. Cash flow tax with a border adjustment should ease location choice pressures. So there are a lot of resources spent on the firm side attributing income, and this can lead to things like transfer pricing and the incentives and games that are associated with that. And then if you want to think about increased incentives for investment and growth, one of the problems with the current tax system is that it subsidizes debt over equity. So something like a cash flow tax would equalize the treatment of those two. And then in particular, something, again, that's become a little bit hotter in recent months is thinking about the return on investment when you separate it from a normal return and a super normal return, and a cash flow is going to exempt the normal return from investment. So that's a lot of economics talk, but it gets to the issue of progressivity. And so if you tax supernormal returns, you might be moving towards a more progressive tax base. So the truth is, like I said, we've been thinking about this as economists for quite a long time, but there's really a lack of real-world experience with the cash flow tax, which is probably part of the inertia towards moving towards something like this. So what we're going to do is specify an illustrative prototype. So I want to emphasize that. We're not trying to model any particular plan or proposal. We just tried to come up with a basic cash flow tax specification. And then we're going to do something called a micro simulation. And we take a historical panel of tax returns, and we move the dollars on the tax return from an income tax to a cash flow tax base. And then we think about the impact on the base and on the firms in particular. Who are winners, who are losers, how are firms moved around as you move between the bases. Okay, so just if you're not familiar with the cash flow tax, I just want to go through the basics of it. So what it is called a flow of funds tax applied to net receipts accruing to a given business. So that's a lot of words, but you basically want to think about it like a bank statement. And so you're measuring the cash going into the business and the cash leaving the business. And at the end of the year, if you had the bank statement, you would have the flow of funds. And so the idea is just to tax the money that's in the corporation. The base can be defined in two ways, and again, this goes back to the Meade Commission and the terminology. So there's an R base and an R plus F base, where the R stands for real and the F stands for financial. So in an R-based cash flow tax, you would ignore transactions that involve financial assets and liabilities. So loans between banks and businesses would be ignored in terms of payments and repayments. Or you could move to an R+F base, which is the most comprehensive, and from a simplification perspective, maybe something you might want to consider, where all cash inflows, less outflows, would be included in the base. So it's a question of how you're going to treat the financial dollars sort of moving back and forth. Economists will tell you that this is economically equivalent to the destination-based value-added tax, so a VAT, but with a deduction for labor. And it's useful to think about that when you're thinking about this sort of in broader WTO compliance, which we're not going to opine on at all, but this is to give it a comparison to what is out there. In practice, it's administered pretty much like the corporate income tax, but there are a few major adjustments that happen. One of the biggest is the full expensing of tangible assets, investments, and inventories. And so what that means is right now firms are depreciating assets according to a depreciation schedule. Some of the complication in the code comes from the depreciation schedule itself. In a cash flow tax, if you buy a building in a given year, you write off the entire cost of the building in the given year. It's not depreciated over the life of the building. The same goes for computers. So any kind of investment that you're making, you write off the full cost in the current year. The border adjustment piece removes foreign sales and purchases from the tax base. And this is where a lot of the talking points have come up in the recent weeks, is what the border adjustment is going to do. In the R base, which is what we are going to specify, you exclude interest, incomes, and deductions. So this is where the tax code leans on debt, and so you can deduct debt payments, and you're taxed on interest income. In the R base, that's removed from the system. In an R+F base, you would think about it differently. And then I just want to point to two papers. There's an Auerbach paper in 2010, and one that just came out with Auerbach and some authors that really walk through a theoretical cash flow tax and what is in and what is out, and all of the, again, incentives and economic underpinnings of those plans. And so that's a really great place to go look for what a cash flow tax is. So what is the border adjustment? This is, again, something that people are thinking very hard about right now and what its implications are. So in a destination basis, what we take is the domestic sales of goods and services, so everything you buy in the US, less the domestic expenses occurred. And so what this means in particular is that purchases from foreign parties are no longer deductible. So if you're importing pieces to your production process, you don't get to deduct those costs in a border adjusted cash flow tax. And then sales to foreign purchasers are no longer taxed. So if you bake a loaf of bread and you sell it in Canada, you don't get to deduct the cost of tax. And why am I talking about baking? Because I have an example here. Just to get everybody on the same page about what's going on. So in this economy, there's a farmer, miller, and baker. And so the farmer, say, buys its seeds in Canada. It sells its goods to the miller. Oh, not clicking very well. OK, so it's going to take, the farmer is going to take the seeds, grow something, sell them to the miller. The miller buys them domestically and then sells the flour to the baker. So the baker is buying all of its inputs domestically, but then the baker sells some pieces of its process in the US and then, say, some in Canada. OK? So we can look at what happens to the miller. Remember, the miller did everything in the US in this example, and so there's no change in their basis from a cash flow tax to a border-adjusted cash flow tax. They're totally unchanged. What you want to think about is the farmer and the baker. So for the farmer, he bought the seeds, say, in Canada, and he normally deducts those from his taxable income and ends up with a cash flow base of $100. We're going to deny the deduction, and so we've increased the taxable income of the farmer. So his liability is going to be bigger for the same rate with the border-adjusted cash flow tax and with the cash flow tax before border adjustments, or an origin basis. And then the baker, we haven't increased his tax liability. We've actually moved him into a loss position because we removed from the tax base the bread that he sold to, say, Canada. So you don't get to you don't tax the $300 of income, and we move him into a loss position. And so what we're trying to think about in this paper is how many farmers are there and how many bakers are there in the US system, because how you treat those under a destination-based cash flow tax is going to affect what the impact of the cash flow tax is. OK. So some things to focus on and what we tried to focus on in setting up the micro-simulation. The first is how comparable the tax base is. So the size of the tax base is going to dictate what kind of rate you can impose for some revenue goal that you're trying to achieve. So does the tax base get bigger or smaller when you move to a cash flow tax, and what happens to the tax base when you do the border adjustment? Secondly, as in the case of the farmer and the baker, we want to think about how to treat losses. Okay, so tax systems broadly face a trade-off. There are firms that are on loss under the income tax. And so there's an economic benefit to refunding those losses for businesses, but there's also a distaste for writing a check to firms from the government. And so what we have right now is sort of a compromise where firms can carry losses backwards and forwards. They don't get a check from the government. And then finally, when you're thinking about the explicit border adjustment versus an origin-based cash flow tax, we want to think about what's happening to the firms. How many firms are impacted by the imposition of the border adjustment, and what kind of losses are caused particularly by the border adjustment? So we'd be worried about exporters, for example, like the baker who's sending goods out of the country and has moved into a loss position, and what that does to their incentives. So in our simulation, the goal is to compare the cash flow tax base to the income tax base that was in the United States. So what do we assume? And that's important to keep in mind when you're looking at the results. We assume immediate transition between steady states. And so we don't assume that you take time to depreciate old capital. It's just if we were to drop firms in a 10-year period into a cash flow tax with all the adjustments that would come, we move to a new steady state, and we assume that happens immediately. We also assume there are no behavioral responses by the firm. So in this way, this isn't a realistic picture of what's going to happen, but what it's going to do is sort of highlight the incentives that come from moving to a cash flow tax, because you can see where things look a little bit funky. We abstract away from the cost of transitioning between the two systems on purpose, because that's a big question and a separate question. And what we wanted to focus on was the fundamental differences between the two bases. And so we want to think about the relative burden. We want to think about the cyclicality of the bases for fiscal planning purposes. You would need to know if you're moving to a more volatile tax base. And then we want to characterize the impact and role of losses, because that's going to be an issue to deal with when you talk about transition. So on the micro simulation, what we did explicitly is we created a 10-year unbalanced panel of firms from the IRS statistics of income. What they do is they do a stratified random sample of actual corporate tax returns. They reflect the initial filing. There's no carrybacks. It's about 110,000 firms. And we take them from 2004 to 2013. And then we take their income tax statement and we take the steps necessary to move their income tax to a cash flow tax. So there are some caveats to using historical panels, which are really important to keep in mind, again, in interpreting the results. The first big one is that any policy decisions that were undertaken between 2004 and 2013 are going to be embedded in the data, and the firms are going to have been responding to that. So for example, there's bonus depreciation going on. Bonus depreciation allows for a set of capital immediate expensing, much like what we're talking about moving to a cash flow tax. So firms are already, in a sense, responding to the incentive for immediate investment or immediate expensing for particular kinds of investment for all but 3 years of this period. And so that's going to make the bases look a little bit similar because the policy is baked in there. Another very big one to keep in mind, we have the macroeconomic business cycle in the background. So there was a big business cycle that happened between 2004 and 2013. The Great Recession is going on here, and any responses to that and the impacts of the firm, which you might think are atypical relative to a normal business cycle. So again, that's going to be embedded in the results that we find. And then finally, the data that we have is limited to what's reported on the tax returns. So that means when we want to do something like a border adjustment, we don't have the data to separate the income statement between domestic and foreign, so we have to impute that, for example. It also isn't well suited to identify financial transactions. But it's not all doom and gloom. There's a reason we did this. There are a lot of advantages to using the micro simulation on the historic panel of firms. So because we're using microdata on actual firms, we can look at who the winners and losers are. Again, how many farmers are there and how many bakers are there when you move to this new system? In aggregate data, you can't see the actual firms, and so you can't count these things up in some sense. But because we're using firm data, we're able to do that. So the microdata is allowing for the evaluation of things like timing effects, responses to the business cycle. Again, we're thinking about the volatility of the tax base. And then the number and types of firms of what's called that are in perpetual loss. Perpetual loss means they always look like the baker. Their taxable income is always negative and they never move out of it. We focus on the R tax base, so that's important. There's a question when you're designing a cash flow tax if we're going to do an R base or an R plus F base. So because our time period spans the Great Recession, there are some funky things happening on the balance sheet for a lot of firms in very particular industries. And again, because the tax data is not well suited to really separate the financial flows out, we think about the R base, and then we exclude the financial industry from our analysis. So this is for all firms but financial firms, and it's an R-based tax. If you look at the Auerbach paper, he talks about business-to-business transactions between firms. There's an equivalence between the R and the R plus F base. What you need to worry about are firms that are making loans directly to consumers. And then you need to explicitly deal with their income statements and how to separate those transactions. So, okay, so this is the border adjustment. So this is the big, I think it's a leap forward in what we've done, but I will tell you it's not perfect because the data isn't available to do this explicitly. Again, the tax data doesn't allow for the identification of domestic versus foreign flows. So what we have to do is we have to impute the detail to get the destination-based cash flow tax. So we do take some information from the tax returns. We take whatever we can get, basically. On the 1118 and the 5471, you can see related party transactions. So that allows us to pick up particular kinds of imports and exports, but certainly not all of them. And so we also take data from the census. And the census breaks down imports and exports by firm size. And this is a departure from everything that was done in the past, because you see in the census tables that the firms that are doing the exporting are the largest firms within the industry. And so if you apply imports and exports to all firms, it's not really a great match to the current state of the world. You also see that the firms that are exporters also tend to be importers. So again, remember with the farmer and the baker, I had one firm that was an importer and one firm that is an exporter. But in the US data, it looks like the firms that are exporting are also importing. And so we impute that detail onto the tax data in order to do the destination-based cash flow tax. But what you'll see is a reflection of the way that we did that imputation, because we can't identify that exactly. So just to show you what the tax bases are looking like, the gray line is the income tax. So that is our current income tax base from 2004 to 2013. The green line is the cash flow base before border adjustments. I want to emphasize a couple of things here. So that's like an origin-based cash flow tax. This is before we've done the border adjustments. We don't think about credits and losses here. This is just measuring the tax base itself. So there's a very big wedge, actually, between taxable income and then the taxes you pay. There's as much as a 50% offset that comes from things like foreign tax credits and general business credits. Those are policy tools left to the policymakers. We're just measuring the tax base. And what you can see when you compare the gray line and the green line is actually the cash flow base, the origin-based cash flow base, and the income base are not that different. Okay, the cyclicality looks roughly the same. They're not moving very differently. And so this is actually, so I've been staring at this for a long time, so I've sort of internalized it, and I have to remind myself it's a surprising result. To people that are worried about moving from an income tax to a cash flow tax, it's surprising that the bases look similar. Recall underlying this is, all but 3 years worth of bonus depreciation. And so some of the big movements actually are in the background here. And so that's probably bringing the bases closer together. But a result of the microsimulation shows that the cash flow tax base and the income tax base by themselves are actually not all that different. The big change is coming when you do the border adjustment. So that's the blue line up top. So the US in this period was a net importer. For a net importer and we deny imports from the tax base, we're going to raise money. Again, it's just an artifact of the fact that during this period we were a net importer. And so you can see here that we had $9.3 trillion in revenue or taxable income during this period. The cash flow tax before adjustments, again, an origin-based cash flow tax, is only about 1% different over the 10-year window, although there are year-by-year differences. But when you move to the destination-based cash flow tax, you get an increase of as much as 50%. Again, why is that coming? That's coming because in this period, we were a net importer. So then, because we've got the microdata, we need to think about what's happening with the losses, because this is one of the pressure points that policymakers in particular are very worried about when you move to a totally new cash flow tax system. And so the microsimulation lets us compare the fraction of firms that are in loss, sort of under the income tax and under the cash flow tax. In 2012, under the income tax, 45% of firms by count, but 20% of firms, when you weight them by assets, were in a loss position. So weighting them by assets is important because although there are a lot of firms, not so many of the firms pay the tax revenue. So 20% of firm assets were in a loss position. And then, like I said, because the base of the cash flow is not so different from the income tax, you get very similar numbers when you compare the two. However, when you move to the destination-based cash flow tax, while the number of firms has not changed very much, as in percent of firms in loss, 42% of firm assets are now in a loss position. So that's quite a big expansion relative to the income tax base, which means that we need to think more about this. I do want to highlight that annual figures by themselves are probably not the best way to look at this. There's a natural churn in income. Firms do move in and out of loss just as a consequence of the business and when their income is measured. And so what we want to think about is actually in an aggregate sense what's happening to these firms. We haven't assumed any policy towards losses. The current policy lets firms carry back losses 3 years and forward, I think, 20, and so they can move them back and forth, although not indefinitely and without interest. What we're going to do is net each firm's tax base over time. So we're going to sum up their taxable income every period. And that way we're mimicking this. We're letting them use losses in previous periods to offset gains in future periods. And then we're going to think about the impact of an alternative treatment of loss. Again, economists would tell you that you should fully refund this to get the right incentives in the system. And so we need to think about what the difference is. So evolution of firms and loss. What this table is showing is that if firms move from the income tax to, on the left, we have just the cash flow tax, the origin base with no border adjustment. And on the right, we have the destination basis. And what we're trying to figure out is take a tally of firms that were taxable in aggregate in the income tax that remain taxable in the cash flow tax, or in the destination-based cash flow tax. You have your hashtag built into the table, so you're good to go. So 46% of firms in the income tax that were taxable stay taxable when you move to a cash flow tax, and that's roughly the same story that's told in the destination basis. We're trying to think about the firms that were moving into loss, like the baker, when we move to this new system. So you can see the off diagonal is what we're worried about. We're worried about the firms that might have been in loss that were moved to a taxable position, like the farmer, and vice versa, the firms that were taxable that moved into loss. So as I alluded to in the census data, it does indicate that there's concentrated cross-border activity. So there is going to be heterogeneity by firm size in these tables. So for example, for the largest firms, 73% that were taxable stay taxable. So we're not moving many of the big firms into loss. But there's still 10% of firms that do move to a loss position because of the change in tax base. And again, you need to be aware of that when you're thinking about the design of the cash flow tax. What do you do with those firms that used to have a tax liability that now are moved into a permanent loss position? And again, permanent loss means when we sum the taxable income over the 10-year period, they never become taxable. Their losses are so much that they don't offset their taxable income. Okay, and so now I want to just think about the alternative treatments of losses, since this seems like a pressure point, and what can we do about this? So in column 1, we impose refundability of losses. Again, what the economics argument is there is to refund losses to get the incentives correct, compared to column 2, which is carrying losses back and forward as we have in the current system. And we want to think about the difference in losses that are coming from these two different treatments. And so under an income tax, losses were 18% of the tax base, and under a destination-based cash flow tax, they're 24%. So we are increasing losses in a way that you might expect if you saw the little economy that I made up. And so we do need to decide what to do about the losses. And there's not an obvious and easy answer to that, but there are going to be firms that are moved into a loss position and more than under the income tax. Regardless of the treatment of losses, if you were trying to think of a revenue neutral rate, so raise the exact same amount of money between 2004 and 2013, that would give you a revenue neutral rate. You can see that the tax base, again, because we're a net importer in this period, is nearly 50% bigger. And so you can imagine that a revenue neutral rate would be considerably lower than the top rate of 35% that's going on right now. But I just want to keep emphasizing that that result is hinging on the fact that we were a net importer in that period, and that's important to keep in mind. Okay, so the truth is that in the real world, there's no experience with a cash flow tax. And so while policymakers are interested in this, we find, if you read any of the opinions, it's hard to imagine how to move to this because there's no empirical experience to lean on. And so what we try to do with this paper is to bridge the gap a little bit, to think about if you move to a steady state, what are we doing to firms? Because that's going to indicate where the pressure points are coming from. How are firms likely to respond to this cash flow tax? So we find the destination-based cash flow tax would have been significantly larger during this period, that it's a little bit less cyclical, and in aggregate, it's not moving the majority of firms into loss. But there are certainly firms that are moving into loss in a perpetual state that need to be addressed. There are some things we left out. Again, important to keep in mind when you're trying to interpret the results. As I said, we punted. We left out the financial firms. We didn't think about the R+F base. That's going to be a hairy problem if you're trying to think about what the appropriate way to tax financial firms is. And then another big goal of tax reform might be to think about how to tax pass-through businesses like partnerships and S corporations, and we do not have them as this calculation. This is just subchapter C corporations. So this isn't going to shed light on how their tax base may move when you go from an income tax to a consumption tax. We showed that careful consideration should be given to the treatment of losses and credits. So there's an increase in losses that are coming under the new system versus the old. And so maybe the old rule of carry back and carry forward isn't the right way to go. Maybe there should be an adjustment to that. And then the elephant in the room that we're ignoring, again, we're going to punt financials, and we're also not going to talk about how you would transition from one to the other. So the design choices about transition and the economic effects of moving from an income tax to a cash flow tax are going to be very real, and something that is left to the reader to opine on. That's it.
Thank you very much.